Bitcoin is at a tipping point. That is the title of a recent report by the Citigroup research team about Bitcoin and the Bitcoin markets. And it's quite a banger. Packed full of data, insights, and analysis. However, it is extremely comprehensive. In fact, it's over 100 pages long. Now, I know that you good people have a lot of other things to do, like work, chores, and of course, watching the crypto markets. So, I took it upon myself to read through the report and summarize some of the most important pieces in it. You're welcome. So, if you want to know exactly what the Wall Streeters are thinking about Bitcoin, then this is a video you just cannot afford to miss. Before we hit the ground running, I have to lay out some ground rules. Although this content may keep you grounded and your ear to the ground of the crypto markets, I am not a financial advisor. That means that everything that follows is for educational purposes only. It's to help you hit the ground running. Now, with that salt of the earth disclaimer out of the way, I want to welcome all of the new viewers today. My name is Guy, and I'm your guy for everything crypto. We're talking news, reviews, analysis, coin tips, and DeFi deep dives. Sound appealing? Well, may I direct your attention to that subscribe button. Give it a click and flick that bell as well. That makes sure that you have all notifications turned on and this content won't fall through the YouTube cracks. And finally, for your convenience, I've placed all these timestamps right here in the video timeline. Feel free to skip around. However, I do suggest you try and watch this one the whole way through. Okay, we all set? Let's dive in. Let's kick it off with Section 2. Section 1 has a lot of basic information about Bitcoin and crypto, which I'm sure you already know quite a bit about. So, in Section 2, they talk about how the crypto market has evolved. You can see how Bitcoin has gone from a new nascent technology to a form of currency that is widely acknowledged. They point to the fact that it's offering a clear alternative to the US dollar based on, quote, political, economic, or trade concerns. I also like this point that they raise about the potential for governments to ban or limit the spread of Bitcoin. As I pointed out in my video on Bitcoin bans in India and Nigeria, you cannot ban a decentralized and permissionless cryptocurrency. Speaking of that ban, though, it seems as if the Indian Ministry of Finance has realized that and reversed its stance. Maybe they watched my video and realized how fruitless their efforts were. Happy to have shed some light, chaps. Anywho, back to the piece. They then go on to talk about some of the places that Bitcoin is accepted as a medium of exchange. Some of the most interesting of these include KFC offering a Bitcoin bucket. Ooh, delicious. Burger King accepts Bitcoin in some countries. The American Cancer Society takes Bitcoin donations. AT&T accepts payments for some services in Bitcoin. And it's used by the Miami Dolphins and Dallas Mavericks to buy tickets. Now, that's a pretty diverse list, and it's only a few of the examples that they mentioned. The point is that even if many customers don't end up using Bitcoin here, the fact is that it's entered the public lexicon. It's Bitcoin marketing on a mass scale. Now, taking a look at the broader data, they cite an HSB report that at least 36% of SME businesses in the US accept Bitcoin. It's not just small businesses, though. They talk about some of the most recent corporate purchases of Bitcoin that have raised a few eyebrows. These include the likes of Marathon Patent Group, Tesla, and of course, MicroStrategy. This trend of corporates buying Bitcoin for their treasuries was one that I noted last year in my video on corporate adoption. They are trying to hedge out the risk of dollar devaluation and inflation from their balance sheets. Now, this is of course the experience in developed markets, where Bitcoin is seen as a nice to have. In many emerging markets, it's seen as a necessity. Here are some stats from countries in Africa. Transfers under $10,000 jumped more than 55% last year. Money transfers rose by half. A 55% raise in trading volumes in South Africa and Nigeria. Now, the latter is actually an important point, and it's one that I raised in my video of Bitcoin adoption recently. Many merchants and importers in Nigeria have turned to Bitcoin in order to facilitate their businesses. Their local currency is just too volatile. You can watch that video by hitting the link in the top right, by the way. Something else that I really like about this report is that in many of these sections, they have quotes from some of the people that they've interviewed for it, insiders in the crypto space. I like this one from the CEO of Chainalysis. Quote, "Bitcoin is the first global payment system that's accessible to anyone in the world." The next part that I wanted to look at was the argument that they make for the broader institutionalization of Bitcoin. This is mainly related to the transformation of Bitcoin away from the argument of medium of exchange to that of a digital gold. They have expanded on their earlier chart here, and you can see that the focus of Bitcoin as an investment is on its scarcity. I happen to think that it is actually better than physical gold, and it's a topic that I covered in a video I did last year. You can watch that by hitting the link in the top right. After this, they go over a bit of the institutional landscape. Take a look at this figure here, for example. It gives a high-level breakdown of the institutional service providers in the space: data analytics, exchanges, custody, broker-dealers, and compliance. The list goes on. They then go on to break down each of these components and analyze how they've evolved over the past year. I won't go over all of them here, but here are some of the most interesting points for me. For one, we all know how elusive that Bitcoin ETF has been. Everyone has been fixated on whether the SEC would finally approve one. However, there are a number of Bitcoin investment vehicles in other countries around the world. For example, here's a table with a number of these as well as the AUM in each. In terms of when they think that a retail ETF will be greenlit in the US, according to Kathy Wood of ARK Investment Management, she, quote, doubts US regulators will greenlight a Bitcoin ETF before the original cryptocurrency's market cap hits $2 trillion. Well, if Bitcoin hits 100K this year, not unlikely, we could be seeing a $2 trillion market cap. So it'll be interesting to see if this prognostication comes true. Something else that I found interesting was their analysis here of the OTC dealers. For those that don't know, OTC, or over-the-counter trades, are usually done for large block orders off of exchange books. This is where a lot of whales will try and pick up or offload coins without spooking the market. Given that these are usually opaque, it is hard to get a sense of how they've evolved over the years. Well, according to the report, they have now gone almost electronic, and the spread on these trades has gone down from 50 to 200 basis points to 5 to 10. This shows that they're becoming much more liquid, and hence more palatable for institutions. Another really interesting trend that they point to is the rapid expansion of custody services. A number of different banks and asset management firms are offering custody solutions. What's the significance of this? Well, most large investment funds have mandates that they're not allowed to invest in funds that are not securely held by a qualified custodian. With these firms, there are more options for storing these funds now. They are providing the right infrastructure to be able to safely and in a compliant manner invest in crypto. And speaking of regulation and compliance, this is something else that the report goes over quite a bit. There are a number of US regulatory issues that they think are likely to shape the narrative this year. These include the Financial Action Task Force Travel Rule, the Securities Exchange Commission Cryptocurrency Custody Letters, the Office of the Comptroller of the Currency's interpretive letter on banks using blockchain networks for payments. Now, I've covered each of these to certain degrees on the channel. The first of those relates to the self-custody of crypto funds and KYC requirements by exchanges when it comes to their users wanting to self-custody. You'll recall that the ex-Secretary of the Treasury, Steve Mnuchin, was trying to force through overburdensome travel rule interpretations. Now, thankfully, this was stopped dead in its tracks. The custody letter is closely related to what I just mentioned. The SEC could be providing an avenue for US-based broker-dealers to custody certain assets. Finally, the OCC move to allow banks to operate as nodes in a payment network is a big deal, especially for stablecoin issuers such as Circle and its USDC. It's also great for those networks where these stablecoins could run, including Ethereum, Stellar, Solana, and Algorand. Oh, they also do take a look at some of the rules that have been implemented in other countries. You'd be quite surprised to see how receptive some of these other countries have been to digital assets. If you're wondering why US regulations are often lagging behind these countries, this quote by Michael Shorlov of Fireblocks should put it into perspective. Quote, "The US has lagged from a regulatory standpoint, but the problem with the US is the amount of regulators. In Germany and Singapore, there's only one regulator. In the US, you have the OCC, the Fed, CFTC, SEC, etc. Preach, my man." The next section of the report covers broader market trends that the authors have been examining. For example, over here they talk about the increasing liquidity in the Bitcoin market and larger depth. As I mentioned above regarding OTC trading, increasing depth and liquidity means a more friendly environment for institutions. It makes markets a lot less volatile and means that larger orders can be executed without impacting on market slippage. Quite simply, more liquidity means a more mature Bitcoin market. I already pointed out the reduced spread that we were seeing in the OTC market, which pointed to a much more efficient market. However, there have also been crazy amounts of volume taking place here. In fact, in early 2021, the folks over at CryptoQuant noted that the number of transactions between all addresses and exchanges was on a downtrend, something that indicates a large amount of the trading was taking place OTC. But of course, it's not just the OTC dealers. The large centralized exchanges have also seen an explosion of volume over the past year. They're at levels that have not been seen since 2017. But volumes can sometimes be deceptive, as they don't really give an idea of market depth, something I mentioned before. So, take a look at these two graphs here. They give you an idea of the average bid-ask spread on trades of 10 BTC and 100 BTC. As you can see, this has been trending lower over the past 5 years. Lower spreads equals higher liquidity equals more favorable trading conditions. Let's come back to investment products. As I mentioned earlier, there are a number of investment vehicles that have opened up outside of the US. Well, one of the most well-known vehicles in the US for institutional investors is, of course, the Grayscale Bitcoin Trust, something that we've talked about a number of times on this channel. An interesting trend that's captured here in the chart is the steady decline that we've seen in the Grayscale fund premium, essentially the premium the shares trade for over the net asset value of the Bitcoin in the fund. So, what does this possibly show us? It shows that the demand to hold GBTC shares is less pronounced than it was in the past. Institutions are increasingly moving to holding physical Bitcoin, and pricing has become more efficient for the Grayscale funds. Moving on though, they took a bit of a closer look at some of the macroeconomic factors that were driving Bitcoin demand over the past year. As I've mentioned on the channel before, the government response to COVID-19 could lead to boatloads of inflation and devaluation of the US dollar. Take a look at this graph of the growth in the US money supply. This money has been flooding into the system, and every economist under the sun is of the view that we are likely to see those longer-term inflationary pressures come through. Heck, it's even something that Jay Powell himself predicts and is not afraid to admit. This threat of medium to longer-term inflation has led many investors to search for attractive inflation hedges. Hedges that actually have a limited supply that cannot be impacted by the policies of a centralized authority. I actually did a video on this exact topic. And yeah, you know where to go to get that good stuff. Now, look at this photograph. It's a chart that shows the amount of dry powder that's yet to be deployed in private investment markets. These institutions are sitting on oceans of cash, just dying for a place to find yield. For those funds that are sitting in cash, they are generating sweet Fanny Adams. Imagine if only a small proportion of this dry powder is deployed to some really interesting high alpha alternative assets that don't devalue when that money printer goes brrr. Speaking of which, there's also this graph that has mapped the price of Bitcoin versus the US M2 money supply. Now, you don't need to be a statistician to see that there is a positive correlation here. They then point to some further research that was done by a crypto research firm that compared gold supply and expenditure in the gold mining space to that of Bitcoin. For example, the supply growth of both gold and Bitcoin is at about 1.3% per year. However, the Bitcoin supply growth tapers off as we go through these halving events. This is a large component of the stock-to-flow model, by the way. If you guys don't know what that is, then I've linked to the legendary post by Plan B below, which should give you more guidance. Oh, they also point out that in order to bring that gold to the surface, gold miners spend over 44% more than Bitcoin miners in capex on an annual basis. And as an aside, I should also point out to all the environmentalists out there that gold mining is incredibly damaging to the environment. They literally dig massive holes in the ground and use toxic chemicals to extract it. What about Bitcoin? Well, all it requires is power which can easily be generated from renewable sources. In fact, in China, a large proportion of the power being sent to miners in Sichuan province is coming from hydro. But I digress. Back to the report. Over here, they go over some more institutional adoption trends, all the way from VC firms such as Andreessen Horowitz to university endowments such as Harvard and Yale. I find it quite incredible that Bitcoin is an asset that not only fits the return profile suitable for a high-risk VC fund, but also the capital preservation qualities required by these endowment funds. Talk about magic internet money. On top of that, they have these graphs over here. These are some on-chain metrics that not only give an overview of the total amount of whale Bitcoin addresses, but also that the holding time of these addresses has been increasing. People are slowly but surely realizing the virtue of the hodl. These guys over here, for example, are hodling for 5 years or more. Would you be able to? Let me know in the comments. They then also refer to these two other surveys, namely the Bitwise Asset Management Survey and the Fidelity Digital Assets Study. I've covered the latter on the channel before. This was basically a survey where they spoke to a large swathe of institutional investors and got their take on investing in crypto. Some of the most illuminating stats from that for me were 26% have some exposure to Bitcoin, 58% had a positive or neutral view of it, 80% expressed interest in institutional investment products. Now, could you have imagined that we would have had traditional money men holding that view of Bitcoin only a few years ago? We really have broken down the barriers traditional finance has thrown up at us. In terms of that Bitwise survey, they found that the number of financial advisors suggesting an allocation to Bitcoin had risen from 6.3% in 2019 to 9.4% in 2020. As I always say in my videos, consult your financial advisor. It's for good reason. Moving on though, the next two sections of the report look at the broader cryptocurrency ecosystem and the role that stablecoins and payment rails are having on the financial landscape. In the interest of time, I won't go over them here, but feel free to give it a read at your leisure. The final section that I want to cover is on the potential risks and challenges that Bitcoin faces. Despite how much we would like to dismiss many of these concerns as FUD, they are important to address. And the chaps at Citi do a pretty good job of that. For example, one of the most often overlooked barriers to entry for institutional investors is the lack of capital efficiency. All trading and financing is pre-funded, and all lending is over-collateralized. Therefore, the capital that these investors place in crypto cannot be leveraged to access loans. Even if it can, there are such stringent requirements for that capital that it would not be efficient for these institutions to use it. We can, of course, contrast this to the numerous financing methods available for traditional financial instruments such as bonds, equity, etc. This is exactly what Michael Morrow of Genesis Trading says, quote, "Balance sheet matters. What matters in equity prime will matter in crypto prime. Access to a cheap cost of funding will be a key factor." Another challenge that they mention is the concerns around insurance and custody. Sure, there are a range of custody solutions currently that are serving the market, but they still don't suit a lot of investors. For example, there's currently a lack of traditional regulated brand name players in the digital asset custody space. Most of the custody solutions that do exist are with newer and third-party custodians. Moreover, there are limited options for the insurance of digital assets at these custodians. Indeed, given the nature of digital assets, one could imagine insurance premiums on crypto custody could make it unfeasible. Most of these concerns are, of course, justified. Securing crypto is a lot harder than securing a bond or equity. Despite the fact that illicit crypto activity fell last year, news of hacks, scams, and ransomware have an outsized impact on public perception. All you need is headlines like this to be shared in some boomer banker chat groups, and it drives the narrative. Then, of course, we have the never-ending questions around Tether. Sure, They may have settled their case with the New York AG, but there are still concerns around its impact on the Bitcoin markets. For example, some market participants view a Chinese government ban of Tether as a potential black swan for the Bitcoin markets, a topic that I covered in one of my recent email newsletters. Another concern that they raise is one of my favorites, the environmental impact. They point to the raw amount of power that's required in order to mine Bitcoin and the environmental impact of producing that power. As mentioned, I don't think that this is much of a concern given the move towards renewables globally. Thankfully, they do mention this. For example, over in Texas, where a lot of miners are moving, there is ample wind power. Another risk they go over is competition. More specifically, they wonder whether there could be another cryptocurrency that could overtake Bitcoin. Honestly, I think that's wishful thinking. Bitcoin has become the de facto digital gold, and there are no other cryptocurrencies that come close to its instantly recognizable status. Sure, there are other cryptos that serve different purposes, but they should be viewed in that light, not as competition to Bitcoin. I've been in the space for some time, and I've seen many projects try to replace Bitcoin. They all end up inevitably failing. One final factor that they look at is one that I think is a bit more concerning, and that is the broader shift in macro investing trends. Currently, there are fears around inflation because of the excessive monetary stimulus that followed the pandemic. However, if global economies rebound much more strongly, then this monetary stimulus is likely to be drastically scaled back. This could lead to a shift in the narrative of inflation hedges and lead to the institutional investors reallocating capital back to traditional assets. If China's economic growth last year is anything to go by, there is a reasonable chance that countries in the West, like the US, are likely to also see some strong growth numbers this year. It'll be interesting to see what impact Biden's stimulus will have on US growth in the first and second quarter of this year. You should also keep a close eye on that vaccine rollout and whether it's likely to lead to more countries loosening lockdown restrictions. Basically, we cannot just view Bitcoin in the context of the crypto markets. It is a global macro play, and we have to take a look at global macro factors. Well, that was a really interesting report, guys, but I wanted to give you one or two of my own personal thoughts on it. I actually think it's quite optimistic, especially for a report that was drafted by bankers for bankers. It's light on FUD and thick on facts. It covers many of the same factors that I've talked about on this channel in the past. Everything from corporate balance sheet preservation to institutional fund diversification and broader market liquidity. All of these factors are helping to shape a more robust and inclusive Bitcoin ecosystem. From VC firms to mutual funds, from hedge funds to endowment funds. These investors really get it now. They understand the reason that folks like me and you have such a love affair with Bitcoin. And this is only the type of report that's been made public. We cannot forget that these bankers are drafting private reports for their own clients. And there are indications that they're just as bullish in these. Case in point, the contents of a recent JP Morgan private clients report was leaked. This is for those people who have accounts at JP Morgan with over $10 million in funds. They tell these clients that if sized correctly, Bitcoin can be an effective portfolio diversifier. And I'll remind you that this is from a bank where the CEO once said that Bitcoin is a fraud. And, quote, if you're stupid enough to buy it, you'll pay the price for it one day. Well, you're right, Jamie. We are stupid enough to buy it, but not stupid enough to keep $10 million at your bank in order to be told to do just that.
Hey folks, Guy said he had to rush to check his blockfolio, so he asked me to do the outro. We are keen to hear your thoughts on that video. What parts of the report did you find the most interesting? Let us know in the comments below. While you are down there, you may also be interested in our socials page. This has links to all the places that you can follow Guy. These include the Coin Bureau Insider Telegram channel, Instagram, Twitter, our exclusive weekly newsletter which has Guy's personal portfolio. Oh, and we have just launched a TikTok account as well. Over here, I join Guy to bring you some behind-the-scenes fun, as well as short and sweet news updates. That's all linked to below. Finally, Guy told me that if I managed to get more than 10,000 likes on this video, he would give me a Bitcoin bonus. So please help this crypto gal out and hit those likes. Don't forget to subscribe as well, and please don't leave that bell hanging either. Till next time, my fellow hodlers.
Bye.